Hey guys, how's it going? For today, I thought we would talk about a new trading strategy that I've never traded yet, but it is called the poor man's covered call. And this is a strategy if you want to sell covered calls on a stock, but you can't afford to buy the 100 shares in order for you to have basically share collateral or stock collateral to use against the covered calls that you would sell. So what you can do is you can trade what's called a poor man's covered call. So what we'll do is we'll take a look at Tesla as an example because Tesla is still a relatively expensive stock. As we can see, we closed the last trading day at about $405, just shy of $406 per share. So the first thing you want to do when you want to sell a poor man's covered call is you need to buy an in-the-money call that's far out from expiration. So that in-the-money call that you're going to buy is going to act as your 100 shares of that ticker. So for example, let's just go right into the Tesla option chain here, and we're going to buy a long data expiration call option. But the first thing we want to do though, before we buy our in-the-money call option that's far out in the expiration, is we need to decide which covered call we want to sell. So today is Saturday, so the market is not open, but just for argument's sake, let's just say I want to sell a covered call. I want to sell a weekly covered call that expires this coming Friday, which is October 2nd here. So on the Robinhood platform, I'm going to go to sell call, and let's say I want to sell the covered call that is at 420. So I want to sell a $420 strike covered call on Tesla. But like I said, as of right now, I don't own any shares of Tesla. I don't own any options on Tesla because it's too expensive for my portfolio. If you wanted to sell a normal covered call, well, you need to buy 100 shares of Tesla. And since we said Tesla is trading at basically $406 right now, so you need to buy $406 per share, and every contract is always 100 shares. So you would have to buy 100 shares of Tesla at a price of about $406. So that means you would have to spend $40,600 in order to buy 100 shares of Tesla to sell one covered call. So if you wanted to do that, and you could do what's called a buy right, meaning you buy the 100 shares, and then in that same instance, you sell the covered call against those shares that you just bought. But like I said, not everybody, including myself, has $40,600 to spend on one covered call, basically. And the other thing is that will only net you one contract, right? If you wanted to sell 2 or 3 covered calls, where you're gonna have to spend 2 or 3 times as much money to buy 200 or 300 shares of Tesla or any ticker you're looking at. So the poor man's covered call, it's named that way because it does not take up nearly as much capital, and you can still kind of synthetically sell covered calls by not owning the shares, but by owning an in-the-money call option that you bought that's further out in expiration than the covered call you're planning on selling. So getting back to our example here, let's just say I want to sell the $420 strike covered call that expires in a week on October 2nd. And you can see for that, I would collect $12.25 per share in premium. But again, that's per share, and every contract is 100 shares. So we multiply this number by 100, and that would mean that we would receive in credit immediately $1,225 in premium. So that's ours to keep right now, unless we decide down the line to close out this option early or roll it out. But for just the sake of this example, we would collect $1,225 in credit for selling this covered call. Now, just to make the numbers easy, we're going to talk about these numbers in per share. So we're going to say $12.25, okay? So I'm going to write this down here just so that number is easy to remember. So $12.25 is what we are going to plan on collecting by selling this covered call at the $420 strike price that expires on October 2nd, okay? So now that we've identified our covered call that we want to sell, now in order to make it a true covered call, because right now this is just a naked call, which carries a lot of risk with it. To make this a synthetic covered call or a poor man's covered call, we now have to buy a call option that's farther out in time, or it expires later than the covered call we just sold. So let's say, you know what? I want to be able to sell covered calls every week on Tesla. So I'm going to buy a call option on Tesla for January of 2021. That will allow me to keep selling covered calls, hopefully, for every week in October, November, December. So what we're going to do next is we're going to go to buy a call now. We're going to switch to buy, and we're going to look for a date that's further out in the money. So I said January, so we have an expiration date here in January 15th of 2021. So that fits the bill. So let's look at the option chain for that expiration. So now what we have to do is you have to buy the call option in the money. So not out of the money. In general, you want to sell options that are out of the money, and you want to buy options that are in the money when you're doing a poor man's covered call. So let's look for a strike price that fits certain criteria. And now you may be asking, well, how do you pick which in the money option to buy? And this is how you do it. So every option is going to have what they call intrinsic value and extrinsic value, okay? So let's just take a look at the $390 strike price here. So as we can see, the value or the premium value of this option is $84.20. But we can see the stock is currently trading at $405.80. So let's just round this up to 406 to make it an even number. So if we say it's $406 and this is worth of a strike of $390, that means that it is $16, right, from the share price to the strike price. So what that means is that it has $16 of intrinsic value, okay? But we can see that it's actually worth $84.20. So this premium value is made up of both intrinsic value and extrinsic value. So if we subtract $84.20 from what we said was $16 of intrinsic value, that means this option actually has $68.20 of extrinsic value. And that's the important number. So I'm going to write that down here. So $68.20 of extrinsic value. Okay, I'm just going to put EXT. So what that means is that now we need to make sure that the covered call that we're planning on selling has more premium than this extrinsic value. So from our example, you can see we don't, because our covered call that we chose only has a value of $12.25. However, the in the money option that we're planning on buying is much more than that at $68.20. So this is not a good trade setup. You need to have your covered call premium be higher than the extrinsic value of the in the money call you're planning on buying. So that means that we may have to go deeper into the money. So let's keep working here and let's scroll down to see what we can come up with. So if I go deeper into the money, so let's say I go all the way to $350, let's say. So let's see what the math is on that. So again, let's just round this to $406. And then the strike price is $350. So that means there is a total of $56 of intrinsic value, okay? But as we can see, the premium is $102.90. So again, if I subtract the two numbers, $102.90 minus $56, I'm still left with $46.90 of extrinsic value, which is again higher than our covered call premium, which is not what you want. That means we are so far apart that we're gonna have to keep going further deeper into the money in order to make this a good trade. So let's go all the way down to $200. Let's go to that strike price. So from about 406 to 200, there is a $206 difference between the current share price and the strike price of this option that we are looking at. So, and the premium is $213 $206.13. And we're going to subtract that because we said that's $206 of intrinsic value. So to calculate the amount of extrinsic value, we're going to subtract that difference from the premium. So $213.13 minus $206 leaves us with $7.13 of extrinsic value. And as we can see, the premium that we're collecting on our covered call is actually more than that. So that will be a good setup. So if I wanted to trade this setup by selling a weekly covered call in Tesla, I would look at buying something like this 200 strike option that's in the money, because now my covered call value is worth more than the extrinsic value that of the in the money option that I bought. Now, of course, you can play with these numbers, right? You can say, I don't want to sell a weekly covered call, I want to sell a monthly covered call. So let's just, for example, do that. And instead of selling a call for October 2nd, let's go to October 30th, for example. So, and let's say I'm just going to hold this extrinsic value steady for the 200 strike on January, okay? So that means I am looking for a covered call that is going to net me more than $7.13 in premium. So let's see. I mean, right now you can see these are much, much better trades because these are way higher in premium than $12.25. So I could sell covered calls that are pretty far out of the money. I mean, I could sell these covered calls that are so far out of the money that I have, let's just say, a 90% chance of profit. I mean, I could sell this 570 strike for October 30th, has a 90% chance of profit, and my premium is $9.70, which is still above the $7.13 for the extrinsic value of the in the money option that I would have bought. So personally, this seems like a better trade to me than the weekly option because I can get a further out of the money option that I'm selling because I have a 90% chance of profit. If I go back to the October 2nd option, we were looking at the 420 strike. That's only a 72% chance of profit, which we can see right here. So I can basically increase my chance of profit by about 20% by giving myself an extra month's worth of time for this trade to be in my favor. And also keep in mind that you don't have to ride this covered call fully at the expiration. You can close it out at 50% profit, for example. That's what Tasty Trade likes to recommend. And basically just rinse and repeat until you get to the expiration date for your in the money call that you bought. And hopefully at that point, you can also close that position out early as well. Or hopefully by that time, you've collected enough premium to compensate for the amount of debit you had to pay to buy that call. So overall, the poor man's covered call is actually a bullish strategy, whereas a regular covered call, it's actually more of a bearish strategy because you own the 100 shares of that ticker and you're selling covered calls against that, usually hoping that the share price does not go at or above your covered call strike price. That way you can collect the premium for free and still hold on to the shares while reducing your cost basis. I mean, if you want to do the wheel strategy, you can also hope that your shares do get called away so you can just keep running the wheel. But for example, if you are a long-term buy and hold trader, you could buy shares of a stock and just hold them long-term while selling covered calls on them and hoping that your shares never get called away. Or if your strike does get tested, you'll just roll those options out. Well, instead of buying those 100 shares or 200 shares or 300 shares, you can just buy an in-the-money call option that's further out in expiration and basically use a synthetic covered call strategy. So I know that was a lot to digest. If you have any questions or comments, hop in our Discord server or leave a comment or a question in the YouTube section below. As always, happy trading.